What's going on, everyone? It's Eunice and welcome back to the channel. Today we're diving deep into the world of trading with a focus on support and resistance levels, the unsung heroes of market analysis. Whether you're just starting out or you're a seasoned trader, understanding support and resistance is absolutely essential for making smarter trading decisions. These levels give you a framework for understanding price action, identifying potential entry and exit points, and managing your risk like a pro. By the end of this video, you'll know exactly what support and resistance levels are, how to spot them on a chart, and how to use them to your advantage in your trading. So grab your notebooks, let's get started. First things first, let's break down exactly what support and resistance levels are. In the simplest terms, think of support as a floor and resistance as a ceiling for the price of an asset. Support is the price level where buying pressure tends to outweigh selling pressure, preventing the price from dropping any further. It's like a safety net where buyers step in and say, "Hey, this asset is a bargain at this price, I'm buying." Resistance, on the other hand, is the price level where selling pressure tends to be stronger than buying pressure, preventing the price from rising any higher. It's like hitting a ceiling where sellers say, "Okay, this asset is getting a bit too expensive, time to sell." These levels are absolutely crucial because they help us identify potential turning points in the market. When the price approaches a support level, it could indicate a buying opportunity as the price might bounce back up. Conversely, when the price approaches a resistance level, it could signal a selling opportunity as the price might reverse and head lower. Now keep in mind that support and resistance levels aren't foolproof. Sometimes, the price will break through these levels, and that's where things get really interesting. By learning how to identify and interpret these breakouts, you can take your trading to the next level. Let's dive into identifying support and resistance levels. Use historical price action, round numbers, and trendlines, moving averages, Fibonacci retracement, volume profiles, and pivot points. Alright, let's dive deeper into historical price action, one of the most reliable ways to identify support and resistance levels. This method is all about finding those key levels where the price has reversed or stalled in the past. Think of it like this. Every time the price hits a support or resistance level and bounces back, it reinforces that level, making it even stronger the next time the price approaches it. It's like a muscle that gets stronger with each workout. When you're analyzing historical price action, pay close attention to swing highs and swing lows. Swing highs are those peaks where the price reverses and starts moving lower, while swing lows are those valleys where the price reverses and starts moving higher. The more times the price has touched and reversed at a particular swing high or swing low, the more significant that level becomes as potential support or resistance. These are the levels where you can expect to see a higher probability of a bounce or a rejection. Now here's a pro tip. Look for clusters of swing highs and swing lows. When you see multiple swing points clustered around the same price level, it's like finding a gold mine. These clusters indicate a strong area of support or resistance that's likely to hold. Remember, historical price action provides valuable clues about how the market has behaved in the past, which can give you an edge in anticipating future price movements. Let's talk about round numbers, also known as psychological levels, and how they can make a real difference in your trading. These are those nice whole numbers that end in double zero like $10, $50, $100, and so on. You might be thinking, really? Round numbers? How can those be significant? Well, believe it or not, they play a huge role in trading psychology. You see, traders are human, and humans are naturally drawn to round numbers. They're easy to remember, easy to calculate, and they just feel right. Because of this, traders often place orders around these levels, whether it's to buy, sell, set stop-loss orders, or take profits. This collective behavior creates these self-fulfilling prophecies where round numbers actually become significant support and resistance levels. It's almost like everyone is subconsciously agreeing on these levels. Now here's the thing. Round numbers tend to be even more powerful in markets that are heavily driven by retail traders. That's because retail traders are more likely to be influenced by these psychological factors. So, next time you're analyzing a chart, pay close attention to those round numbers. They might just be the key to unlocking some incredible trading opportunities. Trendlines are one of the most fundamental tools in technical analysis, and they can be incredibly powerful for identifying support and resistance levels. Essentially, A trend line is a straight line that you draw on a chart to connect a series of price swings. Now there are two main types of trend lines, uptrend lines and downtrend lines. An uptrend line is drawn by connecting a series of higher lows, while a downtrend line is drawn by connecting a series of lower highs. Here's the thing about trendliness. They act as dynamic support and resistance levels, meaning that they change as the trend progresses. In an uptrend, the uptrend line acts as a support level, preventing the price from falling too far. Conversely, in a downtrend, the downtrend line acts as a resistance level, preventing the price from rising too high. One of the key benefits of using trendlines is that they help you visualize the overall direction of the trend. By connecting those swing highs and swing lows, you get a clear picture of whether the market is moving upwards, downwards, or sideways. This can be incredibly helpful for making trading decisions. Another benefit of trendlines is that they can help you identify potential breakouts. When the price breaks through a trend line, it often signals a significant shift in momentum, which could lead to a big move in the direction of the breakout. Moving averages are one of the most popular and versatile tools in technical analysis, and they can be incredibly effective for identifying support and resistance levels. Essentially, a moving average is a line that smooths out price action over a specific period of time. The most common types of moving averages are simple moving averages or SMAs and exponential moving averages or EMAs. SMAs give equal weight to all price data within the specified period, while EMAs give more weight to recent price data. Traders use moving averages for a variety of purposes, but one of their most common applications is to identify support and resistance levels. In an uptrend, a moving average will often act as a support level, preventing the price from falling too far. Conversely, in a downtrend, a moving average will often act as a resistance level, preventing the price from rising too high. One of the key benefits of using moving averages as support and resistance levels is that they are dynamic, meaning that they adjust as the price moves. This is in contrast to static support and resistance levels, which are based on historical price points and don't change. Another benefit of moving averages is that they can help you identify the overall trend of the market. When the price is above a moving average, it suggests that the market is in an uptrend. Conversely, when the price is below a moving average, it suggests that the market is in a downtrend. Get ready to unlock one of the most powerful tools in technical analysis, Fibonacci retracement levels. These levels are based on a mathematical sequence discovered by Leonardo Fibonacci back in the 12th century, and they've been used by traders for decades to identify potential support and resistance levels. Now I know what you might be thinking. Math, in my trading? No thank you, but trust me on this one. Fibonacci retracement levels are surprisingly easy to understand and use, and they can give you a serious edge in the markets. So, how do they work? Well, Fibonacci retracement levels are horizontal lines drawn on a chart that indicate areas where the price might reverse or stall. These levels are based on Fibonacci ratios, which are derived from the Fibonacci sequence. The most commonly used Fibonacci retracement levels are 23.6%, 38.2%, 50%, 61.8%, and 100%. Traders use these levels to identify potential support and resistance zones during retracements, which are temporary pullbacks within a larger trend. For example, let's say the price of a stock has been in a strong uptrend, and then it starts to pull back. Traders will often look to the Fibonacci retracement levels to see where the pullback might stop and reverse back to the upside. The idea is that the price is more likely to find support at or near these Fibonacci levels because traders are anticipating these levels and placing orders accordingly. It's like a self-fulfilling prophecy. In one of the upcoming episodes, we'll take a deep dive into effectively using Fibonacci retracement tools to enhance your trading strategy. Stay tuned. There you have it, everything you need to know about support and resistance levels. I hope this video has given you a solid understanding of these essential trading concepts and how to apply them to your own trading strategy. Remember, support and resistance levels are your allies in the markets, providing valuable clues about potential turning points, entry and exit points, and risk management. Additionally, consider leveraging order blocks to identify key support and resistance levels. Order blocks offer valuable insights into institutional trading activity, providing a deeper understanding of market behavior and enhancing your trading strategy. Stay tuned, as we'll be releasing new videos soon to explore order blocks in greater detail. By mastering these concepts, you'll be well on your way to making smarter trading decisions and improving your overall trading performance. If you enjoyed this video, don't forget to give it a thumbs up, subscribe to the channel for more amazing content, and hit that notification bell so you never miss an upload. Thanks for watching, and happy trading.